Good morning, folks. It's Dave Burrows at Barometer. I thought I would do a quick webcast update this morning given the market action yesterday. I wanted to touch on a few things. As most people know, we believe that we entered a developed market, bull market, in 2013 when we exceeded the highs from 2000. Market rallied in 13 and 14 and corrected in 2015 into 16. Since then, we have had a fairly steady, relentless rise in U.S. equities, and along the way, other various markets around the world have joined the rally. So this has been a rally that has been broadening by the number of markets globally that have been participating, which is a healthy thing. Now, as we can see in the 1980s and 90s, the 1950s and 60s, while markets rallied persistently, there were corrections along the way, and of course, corrections can come at any time. Over the last 18 months, we've had very little Canadian equity exposure, frankly, because breadth in the Canadian market has been weak. When I talk about breadth, we're talking about the percent of companies within that market that are participating in the rally. In a healthy rally, the percentage of stocks doing well should be rising, meaning more and more stocks participate in the rally. Canadian breadth has been weakening all through the year, and as many know, the Canadian market has had virtually no return for the year. What has changed in the last couple of days is that when we look at our other breadth models, breadth globally for the first time this year has shown some weakness. So 6% of stocks globally have reversed down on their long-term trends, meaning that fewer companies are performing well. This reversed down the day before yesterday. At the same time, breadth in the U.S. stock market reversed down. Breadth in the NASDAQ reversed down, joining what was already weak, some weakening breadth in Europe. So look, this is a change. And when change takes place, it's our job to recognize it and deal with it. Barometer has a very specific process that we follow. We like to be invested while breadth is expanding. There's no major correction in history that's ever taken place while breadth was expanding. But when breadth does start to contract, it can be for many reasons. It can be short-lived, it can be longer-lived, and we won't know until we live through it. So what is our game plan? When breadth starts to contract, the first thing we do is we review and reduce our equity exposure by some amount, generally 10 to 15%. We'll go through individual positions to look at risk. We'll go through our sector exposures to see which sectors are weakening, which ones are remaining strong, and we'll use that work to pare down our equity exposure. Second, in the funds and the pools that we run, we will initiate some index hedges to reduce the risk. In other words, we will short a certain amount of an index to offset the risk that could be posed by our existing positions. Third, we go back to our stop losses and we tighten them up closer to the current price to reduce our tolerance for risk. And fourth, because we don't know how long something can go on for, rather make a little mistake than a big mistake. As positions come out of the portfolio, we build our cash weight. So as many remember, in 2008-9, we started raising cash in June with 20%. By the time we got to September, before the collapse in the market, we were between 50 and 75% cash. That's not what we're expecting today, but when breadth turns down, our job is to get a little bit more defensive. And then we reevaluate this daily. We run this breadth work every day. If breadth reverses up, we can take these positions off. We have a number of short-term indicators that we look at to make sure that we have a good handle on what's happening internally in the market. While people are staring at indices that are dominated by the largest companies, we want to know what the average company is doing. So here are our expectations in the short term. We think this is likely a short, sharp correction in a long-term bull market. When we look at the key factors that drive share prices, earnings, we've just come through an earnings period where 79% of companies beat estimates, and we are seeing estimates revised higher. So the earnings picture is strong. Second, Recently, the economic data in the U.S. after a soft patch has started to rebound, and the economic surprise data is improving. When we look at the financial sector, a very important sector for the U.S. market, it very recently made new all-time highs. It's very rare for a correction to start while financials are hitting new highs. When we look at seasonality, yes, July, August, September tend to be weaker than other parts of the year. However, July was much stronger than the seasonal average. If you look at historically, when July was stronger than seasonal, typically August and September are as well. In fact, generally that 3-month period, if July was strong, winds up being positive. And fourth, while I know that it's concerning that we have saber rattling going on in Washington and in North Korea, the history of political crisis is that it doesn't tend to have tons of impact on indices. And finally, investor positioning is not excessive. In fact, flows have not been working their way into equities. Investors have remained quite cautious. But let's just quickly look at the history of geopolitical events. If we go back to 1925, we've listed here all of the major geopolitical events. And in general, in fact, markets tend to be able to shrug them off. Not entirely. In some cases, they turn into something more significant. And we're not going to walk past the issue without paying attention to it. We have seen some weakening breadth. We are in a more defensive spot. So let's just talk a little bit about markets. Since the lows in January and February of 2016, market's been on a fairly steady rise. There have been a number of short-term corrections, but they've been 3% and 4% corrections, not 10 and 15% corrections. This is historically what happens in this stage of a bull market. After the first major correction, which was 2015 into 16, it tends to be you get 2 to 3 years of very shallow corrections. So where could this correction go? Well, of course, we don't know for sure, but we've got some ideas. First of all, if we look at the trend for the market just over the course of this year, it would suggest that there's some support not far below where we are today at 2430 on the S&P, where we gapped open at the end of June. Now, that's a first line of defense. If we were to take a longer-term trend of the bull market since the correction in February of 2016, it would suggest it's not impossible the market could pull back to a level somewhat below 2400, which could imply as much as a 6% total correction, remembering that we're about 2% off the highs today. Again, that's not a significant correction. What is it that we think can moderate impact in portfolios? Well, the first thing is we have a very significant U.S. dollar position. Most of our equities are U.S. weighted, and while the recent rally in the Canadian dollar had a negative impact on portfolios, we believe that this is just another rally that is likely to fail given the current circumstances in the economy, and that the Canadian dollar is likely to back off. The Canadian dollar backs off, the value of our U.S. dollar investments tend to go up. So the first and most obvious thing is when there is political crisis, geopolitical risk, it tends to be that the U.S. dollar gets stronger. But there's more reasons than that. Let's just go through them. First of all, Canadian dollar doesn't tend to do well when there's weak oil prices, and we know that given the changes in the production of oil, volumes have been growing, making pricing very difficult. OPEC is finding that. With prices between $40 and $50 a barrel, it's very hard for the Canadian dollar to be a lot stronger. Second, our Canadian housing market has been very, very strong. In fact, just the transaction costs from the number of trades in the market has been 3% of GDP. So even a 40% reduction in the number of transactions, which is what we're seeing right now, would have a 0.5% impact on GDP. The housing market as a whole right now is about 8% of GDP. So we have been building homes at a very rapid rate. That includes condos. If that slows down, that's likely to have an impact on GDP, and we are seeing a slowdown in major markets. Third, a close to 10-cent move in the dollar has a very significant impact on the competitiveness of our exports and the attractiveness of our tourism. And fourth, auto sales in Canada have been on a tear. If we do a comparison to the U.S. experience, the number of new cars being sold in the Canadian market today is at the same pace as the U.S. auto boom going into 2008. So while we don't think that there's major negatives coming here, it's unlikely that these things are going to continue to add to more strength in the Canadian economy. So the most important thing is when we look at economic surprise in the U.S., it's improving. Economic surprise in Canada is starting to deteriorate. That should have an impact on the Canadian dollar. But again, we'll continue to evaluate the data. We're going to go through our work daily. We're going to continue to evaluate our positions one by one, but in the very short run, we've become more defensive. We have hedged our portfolios against market risk. We've reduced some positions. We'll continue to look at the sector work, and we will update as is required. I want to thank very much for tuning in.